Go ahead.
All right, guys. Hopefully, this is it. So, good afternoon, good morning. Happy to be here. I do have a few things I do want to cover on, and then I want to open it up for questions. If anybody have any questions, anybody has any thoughts, happy to hear those thoughts. But just to get started, I want to start with the Fed fund rate. That's pretty much where is everything is at right now. Everybody's focused on making sure that we have a soft landing. I did create a post on Discord, just kind of walking through what should have happened in July and what happened in September. And I'm going to go to that post. So we're kind of seeing it together. Hopefully that works. All right. I did something right today. So I posted this on in August, right? And one of the things I said, I think, is the Feds are kind of late to the party again. They were late to the party when inflation was skyrocketing during the pandemic, and I think they were late to the party again this time, right? So inflation has been going down drastically month over month and year over year, no matter how you look at it. The Feds continued and kept those interest rates really high. I was expecting about a 50 basis point um, decrease um, in July. That did not happen. They pushed it to September. And in September, they did do 50 basis points, and they hinted at another 50 basis point, hopefully by the end of the year. So that means we're going to get either two more cuts or another 50 basis point cut by the end of the year. So looking at this in terms of just like everything else what we've been tracking so far and what we need to start tracking going forward. So inflation has been top of mind for everybody. Everybody's been really concerned about inflation. With the inflation going down, it's no longer a concern. The bigger concern now is the soft landing, whether or not we're going to end up being in a recession. um, and I think the risk is pretty high in that space, right? I know the S&P is making all time high. The stock market completely, as a whole, is making all time highs, and I know stocks are going up, but I still believe that we need to be cautious. This is still a risk off cycle, and I do believe there's a little bit of pain to come at least in the next few months. So nothing changed from my perspective since I put this thing in August. I do believe the Q3 results that were published for big all the companies, it's been mixed. Consumer confidence is low. Um, Inflation is going down. Now the risk becomes deflation, and the bigger risk becomes unemployment. So on the unemployment, I just wanted to share this with everybody, just to kind of showcase what I'm trying to say here, right? So any gray spots indicates a recession, right? So one, unemployment is a lagging indicator, right? Which means that the market conditions get bad, companies begin to cut. Usually those cuts come usually in technology first, right? So they try to kind of you know uh, lower technology spending and lay off people. That's basically how enterprises deal with worsening economic conditions. And as you can see, right, since 1950, um, if you look at the unemployment rate, right, unemployment, unlike inflation, it doesn't fluctuate. So if it goes up, it goes up for a while. It's a lagging indicator. After the market conditions worsen, companies begin to cut people, right? So it's not a leading indicator where they're kind of realizing these savings at the front end of economic conditions worsening. Usually, companies react to economic conditions by laying off people, right? So or offering less jobs in this case. So if you look at the overall, historically, if you look at the overall rating there, every time unemployment peaked, it did not peak for a month. It did not peak for a few months. It usually peaked for a good year or 2 years before it started to go down again, right? So 1970, there's 19, probably 75, right? 1980, 1990. This is the 2000. This is the dot-com bubble. This is the 2008 real estate crisis, right? So as you can see, when and this doesn't do it justice, right? Because this may look like it's a month. It's actually like several quarters in there. So if you look at 2000, 2010, so this is probably started in 2007 and it ended somewhere in 2009, right? So for the 2 years during the financial crisis that we had in 2008, unemployment was rocketing. We go back again. It's a very short, minute, few months worth of recession, right? After the pandemic, and then unemployment, went all the way down, and now unemployment is starting to pick back up, right? So as you can see, you probably can see the trends now, right? So every time the unemployment rate starts to go up, the risk of a recession gets pretty high. In this case, it has been going up for a while. The only reason we haven't had a recession yet is because it's been too low historically, right? So, but we're above that line, we're above that average line, so we're getting above average again. And that, if that continues to go up, if we go up to 5, then we're officially in a recession. As you can see, this is just to compare it, right? This is recession, recession, recession. So if you look at the 5, every time we went over the 5, a recession was inevitable. So, and that's what we need to watch for the next several quarters. I'm not gonna drill more on that, but you probably get the point there. So that's just kind of one thing I wanted to mention. Um, I'll continue to manage unemployment. Obviously, everybody's attention is going to be on unemployment. I don't think inflation is going to come at play anytime soon. But I do believe overall the Feds were pretty much late to the game. And I do believe I was talking to Hennessy back in August, and we were talking about when the Fed make the decision. Is it going to be a quarter? Is it going to be 25 basis points, 50 basis point? I was solid on 50 basis point, and I'm going to go on the record now, and I'm going to say we're going to see another 50 basis point in November. And I'll leave it there. All right. So risk off approach. So obviously this doesn't change anything. A few months back, and I'm gonna go to that post right now. 1 second. All right. So risk off approach. A few months back now, August 5th, I mentioned that I'm going to be very cautious in. Um, nope, that's not the right post. Sorry, guy. There you go. Um, I'm going to be very cautious with my positions, and I had a plan in mind where I'm going to be selling at high valuation stocks, or stocks that is valuated, or matured from a price perspective as it relates to their fundamentals. Lower my exposure to the consumer cyclical segment, right? So that's pretty much Lululemon. Nike, all these companies in the consumer cyclical industry. So that was my second step, and then I just wanted to kind of raise cash, right? So my fourth step here was to make sure that I'm raising cash. 15% is a little bit too aggressive, right? But I was able to get to about 12% in cash position over the past few months, and I have been able to deploy some of that cash into Amazon, as you can see at the bottom there. I've also deployed some cash into HIMS. I opened a new position in Google at 153, just a very tiny position, just to kind of benefit from the dip that occurred about a week ago or 2 weeks ago now. So I have been I've been allocating some cash to really undervalued companies, but other than that, I'm staying cash rich for now and just kind of holding on and just kind of waiting for opportunities to arise, right? So one thing on this note, Starbucks, right? So I was able to sell out of Starbucks for $80 a share. 3 days later, I also posted about me going into Chipotle, and 2 days later, the Chipotle CEO moves to Starbucks. So Starbucks, the stock, gains about 20%, and Chipotle goes down about 10%. So that was something worth mentioning. That was probably very bad trade, very very bad timing in my opinion. But yeah, I can't read into the future, so I wouldn't have been able to prevent that from happening. Um, so that's pretty much it about um, the market conditions, the economy. Now, I want to talk about companies that are kind of benefiting or going to benefit from um, a lower interest rate environment, right? So those are companies that are going to be debt heavy or companies that are relying on debt to grow, which means, most of small cap is going to greatly benefit from um, lower interest rates. Financials are going to have some benefit to it. Believe it or not, Tesla is going to be a great beneficiary of lower interest rates. Tesla's sales has slowed down as a result of interest rates being high and people unable to afford buying cars or applying for car loans because the interest rate has been so high. So with interest rates going down, I see any company that sells any product or service that is relying on financing that going to benefit greatly from this lower interest rate or the cuts that we had in September and potentially the another cut that we're going to have in November of this year. So a few companies just to mention, right? So I spoke about Realty Income a few times, and I posted Realty Income in the stock hole section back when it was at $51 a share. I know it's now about $61 a share. I still see a lot of upside from Realty Income. I know it did not do well. It did not react well to the news, but that's just because money's moving into those small cap stocks. So it wasn't a hot stock for that day. But I do over the long term, I do see Realty Income continuing to benefit from that. As I mentioned, Tesla. One other position that I do have is SoFi. I do believe SoFi is also going to be benefiting greatly from the lower interest rates. They have a lot of loans that they wrote out at the peak of our interest rates. Those loans that easy if SoFi decides to kind of sell those loans to just another to sell those loans outside of the SoFi balance sheets, they're still going to get a decent return on their loans because they probably have higher interest rates than the interest rates that are being offered now, and they don't have to hold these debts on their balance sheets. So it's a double edge. It's a dual benefit there. So I do believe SoFi is gonna probably benefit greatly from the lower interest rates. I do believe that we can potentially start seeing SoFi going back to the $9 range to 9.50 range. It's been beat down over the past. I want to say I've held it for like 3-4 years, and I've been down 15% on my position, no matter how much I buy at the bottom. So it's been very, very challenging to say the least. But I've also been benefiting from buying great dips, like when SoFi goes below $6.40. I do add several stocks here and there, and then on the most recent run, it went all the way up to 860, and I sold some of my positions at 840. So I'm kind of scalping across as we, or swinging across, I should say, as we kind of go through the process here. But it's still one of the stocks that I'm down on. All right. Any questions about market conditions before we move on to the stock coverage? I do have HIMS that I do want to cover on. I have Lululemon I want to cover on, and I do want to cover on one position, one company that is at all-time high, and I still think historically cheaper. So, any questions about market conditions, portfolio changes? Any questions there? All right, I'll keep moving. Um, Stocks. So I do want to cover on HIMS real quick, right? So I've been posting a lot about HIMS. HIMS is my biggest, well, now it's my second biggest position after Palantir. But HIMS was at one point in time is my biggest position. And I did call out that HIMS is a good buy at $14 to $16 in that range, and I've been staying true to that, right? So I purchased HIMS at 15.50, I believe, 15.50 a share. I also purchased HIMS at 13.75. There have been a lot of negative news on HIMS over the past several months now, specifically related to the CEO selling shares, stock offering, acquisition, regulatory tightening related to the GLP, the GLP-1 compound. So it's been a tough quarter for HIMS to say the least. Fundamentally, I don't see anything changing with HIMS. This is a company, as you can see, this is a company growing at, the most recent quarter, it's growing at 52% year over year. The company is becoming profitable by the day. So we go. Actually, I want to go to Qualtrim. Let's see if I could do HIMS. Again, I'm just going to do the quarterly view here, is because HIMS hasn't been in the market for a while, so the year over year is not going to show. I'm going to share this view again, but I do want to go to the quarterly view for 1 second. Fundamentally speaking, revenue's growing, companies becoming profitable, free cash flows exploding, net income is in the positive, earning per share, we're at 8 cents from an earning per share perspective, cash to debt, very healthy. I don't know what this is. I looked everywhere and I don't see where this $9.84 million in debt coming from. HIMS doesn't have any debt at this time. So maybe this is something wrong with Qualtrim, but I've been looking everywhere and I can't see where that's coming from. I know they had a revolving credit at one point in time, but to my knowledge, that shouldn't count as debt, but I'm not sure where it's coming from. So those are the good things. Ratios. So SoFi from a ratio, HIMS from a ratio perspective, the return on invested capital is increasing quarter over quarter. I mean, everywhere you look, capex. That's something that I've been watching. Their capex, they're not increasing their capex spending by drastic amounts. So as you can see here, quarter over quarter, this is a cumulative, by the way, right? So from Q1 to Q2, they haven't spent a single dollar extra on capex, right? So overall, I don't see anything bad with the company. Now, I want to talk about a few things that there should be a concern. It's a risk, and we need to be. I don't want to be biased just because I own the stock, so I always try to dig holes into my thesis and try to really just kind of watch those risk items. So one of the biggest risk items that I do want to watch is the shares outstanding, right? As you can see, quarter over quarter, HIMS has been very steady as it relates to issuing shares. This is a company that's still growing. This is a company that just turned profitable. So it's totally expected that we'll see some dilution, right? My biggest concern here is that quarter over quarter, that dilution is actually increasing, not decreasing, right? I know they just did some offering. They offered shares. The reason for them offering the shares was to acquire a pharmacy that is going to enable more GLP-1 and more long-term hormonal therapy to be something that HIMS would end up selling to their customers. However, I still don't like the fact that we are being diluted, and we're being diluted by a large ratio, at least over the past 3 quarters or so. The explanation to this, or my explanation to this, is that HIMS is choosing to offer shares as a form of debt to kind of begin to take loans from shareholders. And they do pay back those shareholders in share buyback, and I'm going to talk about that in a second, right? Nonetheless, it's not net. We're offering more shares than we're buying. Therefore, we are being diluted, and that's not something I'd like to see continue in the future, right? With the free cash flow exploding, I don't see any issue with HIMS, acquiring some type of debt, to kind of pay for capex or whatever it is that they want to pay for, like the acquisitions that they're looking to do and all that. I would like to see that come in the form of a debt, so it's clean from an accounting perspective. Whenever I see shares being diluted, shares being repurchased, and a company that has zero debt, That leads me to think that this is another way to get around the financial statements and just kind of make sure that we're looking healthy from a financial perspective, even though we're diluting our shareholders. So not something I want to see, and I'm hoping that that would get under control. So this is something that I built into my HIMSS metrics, and that's something I'm going to be watching going forward. Expenses. One thing I do want to mention about expenses is their marketing spending, right? I know it's still growing its brand, and I know this is necessary pain at this point to make sure that the company is spending enough money on marketing to begin to acquire more people or more customers. But I would like to see this at least sustain at a single-digit increase rate, right? This is way too much money being spent on marketing. If we're going to be spending that much money on marketing and we're going to be spending a lot of money on capex, we may be stretched a little bit thin from a free cash flow perspective, which is not good from an EPS perspective. So you can see how this could impact the fundamentals in the future. So again, something for me that I'm going to continue to watch going forward is our marketing spending. And hopefully we can see this slow down at least for the next few years. If we're going into acquisition mode and if we're going to be acquiring more pharmacies, we can't be acquiring pharmacies, so we can't be spending a lot of money on capex and increasing our marketing spending as well. The CEO sale, right? So there have been some news that the CEO has been selling his shares. When I looked into it, I think I posted something in there. But the bottom line here is that the net again, the CEO did not lose any shares. So this is predetermined. There are some. Here you go. This is the post. There's some regulatory requirements related to controls on insider selling. So which means that it's that somebody who works for a company should not hold more than a certain amount of shares. They also get paid in the form of stock options. So those options come to maturity and they're holding more shares. So the only way for them to kind of really execute those options is to sell some of the shares and then buy the corresponding number of shares in the form of options. In this case, that's exactly what happened here. I did benefit greatly from that dip because I purchased another 50 shares, and I also purchased a leap, a $10 strike price for January 2026. I purchased it at $6.90, and I think it's at somewhere in the mid eights right now. So I did buy the dip when that news got released, and it was a good buy at least for now. So. Acquisitions, I spoke about acquisitions. The offerings, I did speak about the offerings. So that's it for HIMSS. Lululemon. So Lulu has been one of those companies that really keep me up at night. So I have been invested in Lululemon since May of this year or April of this year. The fundamentals of the company, again, let's just go to Lulu real quick. The fundamentals of the company is great. Everything looks good from a fundamental perspective, right? Revenue still growing. Free cash flow is not growing as much as I would like to see. But again, it's still at a decent rate. Their margins are still good, right? So the story is still intact, right? Net income is growing quarter over quarter. Earning per share is growing quarter over quarter. Again, to my knowledge, and I did a lot of research on this, and this is why I think Qualtrim is broken. Lululemon doesn't have any debt. So I don't know where that $1.8 billion came from. I looked everywhere and I can't just find it. So it could be me. If somebody knows something, I know there were some folks on the chat or in the chat that held Lululemon. So if you see something that I'm not seeing, please let me know. But from my perspective, this is a company that is financially very healthy. This company does not have any debt at the current moment. I do not count capital leases as debt. This is not real debt. This is debt that's covered by assets. So I don't really consider that debt. Shares outstanding, they're buying shares back. I know they just purchased more shares at $310 a share, which was, to me, was not really a good news, right? So in the most recent quarter, they mentioned that they purchased shares at in for Q2 on average of $310 a share. Um, I would have liked to see that average price goes down a little bit, and I'm going to tell you why. And that's the difference between different leadership styles, right? So when you approve a budget and when you allocate, let's say, $50 million for stock repurchase, right? You have to be very purposeful in the way you allocate that cash, right? Um, as a management company, you have the advantage because you know the fundamentals of your business, you know the kind of challenging environment that you're going into. So, as a management team, I would have expected them to buy most of their shares in the lower ranges, right? So in the lower $200 ranges, and then that would have decreased their average price by at least another $40 or so. So it's like, somewhere around like 260 or $270, $270. But for the fact that they purchased at $310 leads me to think that there's a little bit of disconnect from a leadership perspective. And just to elaborate and show you the difference, right? I recently posted something about hymns, right? And I want to make sure that everybody sees this, right? So the company announced a program to repurchase up to $50 million of stock over the next 2 years, aiming to capitalize on moments when the market value of their shares was below their intrinsic value, right? This is a company, this is a management team that is not just going to be buying their shares, but they're going to be buying their shares at an attractive valuation. Well, some of you may say, hey, you can't really tell the future at this time. If they're buying at $310 a share, there's no way for them to expect that the stock is going to fall to $220 a share after they purchased. But in my opinion, I think they knew because they knew what kind of challenges that they're going into. They know what kind of headwinds that they have with their America's growth and the fact that the men is growing faster than women, the fact that they paused some of the new products that they released. All of these items should have led them to think that the stock price was going to go down and they should have purchased more at the true bottom rather than $310 a share. Again, I'm not going to spend a lot of time on this one, but in my opinion, this is a sign that there's a little bit of confusion at the leadership level on the Lululemon side. So not something I wanna see as a shareholder, but I also understand that they have gone through reorgs where some of their key leaders left the organization. They've also have been navigating through one of the toughest macroeconomic conditions that really existed over since the 2007 2008 economic crisis or financial crisis. So I know there's a lot going on and there's a lot of moving posts at this point in time. But again, just something for me that I noted that I don't really like about the most recent changes and the most recent actions that took place on the Lululemon side. With that being said, my next steps from a Lululemon perspective, I am considering lowering my exposure. I have a pretty large position with Lululemon. It's my fifth, or now it's my sixth largest position. And I would like to kind of see that number go down a little bit to maybe to make it more about 5% of my overall portfolio rather than the 10% that it's at right now. So I am going to be trimming some at the top. I trimmed literally one stock at $279. And I do plan to continue to do that, to continue to raise cash, continue to lower my exposure to consumer cyclical, and at the same time, just literally lower my exposure to Lulu in the future. If I get a dip lower than my sale or the trims that I've been trimming, and if I see the valuation going back in line, then I can potentially begin to add more. But at this time, I am starting to consider really scaling back on my position with Lululemon. Now, moving on to my next topic, right? So with the current economic conditions and the interest rates being lower and all that stuff, right? So inflation being in the mirror view at this point, right? So I've been looking into, finding positions that one pay dividends, position that is very undervalued, if I can find one, and a company that would continue to increase dividends month over month. I'm sorry, quarter over quarter, year over year. Sorry. Um, so I've been looking around, and I just subscribed into this tool here. This is it's called FinChat, and I am in love. So I've been using this tool, but the good thing about this tool is that, as you can see in the resources, there's a super investors section. That super investors section is really informative. It tells you what kind of buys and sells the super investors are happening and what their portfolios look like, how it changed. So I've played around with this for a little bit, and I found this guy here. So Chubb, CB, that's the ticker symbol. Um, it's an insurance company. You wouldn't expect an insurance company to grow at these levels, right? So, over the past 5 years, let's cut it to 5 years. Over the past 5 years, this is a company that has been growing at, where's the rate? There you go, 84% over the past 5 years. This company is currently at all-time high. So you wouldn't think that you would look at a stock that's at all-time high and would think it's undervalued. But this stock is truly, truly, truly undervalued. So let me talk about some of the undervalue indicators that I used. So let me use CB again. Free cash flow yield. Look at that, 13%, right? Usually a good acceptable free cash flow yield is anything above the current interest rate values, right? So if you were to put your cash into a government bond, right, you would probably end up getting somewhere around like 4.75%. That aligns to the new Fed fund rate. So for a company that yields from a free cash flow perspective 13%, 13.86%, that's pretty impressive. This is a huge sign of undervalue, right? You look at their profit margins for an insurance company. For an insurance company, I did some comparable analysis. I compared it to Progressive. I compared it to multiple insurance companies. Their profit margins are pretty decent. This company is growing on a quarterly basis, year over year, at double digits, which is unheard of in the insurance industry. I do work in a financial slash insurance company, so I'm pretty familiar with that business model. And I know those companies are truly, truly under a lot of pressure when it comes to margins and profit margins and even earnings at this time. But seems like this company is really is doing great, right? So the one thing I don't like off the bat, right, is the fact that they're net from a cash perspective, they're net negative, which means that they are underwater when it comes to debt. But I'll show you why I still like this company, even it is pretty lopsided. I don't usually invest in companies that are not financially healthy, but that's the nature of the beast, right? So insurance companies, they do acquire a lot of debt. That's part of their business. So this specific metric is not going to apply, but I would also like to see this rate here go down a little bit, right? And I'll show you why I think this is a great investment, even though it's net negative from a cash perspective. This is a company that pays dividends, and as I said, I've been looking for companies that pay dividends and growing their dividends, and we're going to go into the dividend growth for this company in a minute. But their payout ratio is pretty healthy. Payout ratio means that how much of their cash the company is using to pay dividends. Usually a good rate is somewhere around like 35%. So the fact that they are at 14% and they're yielding about 1.25% is pretty impressive. The one thing I want to note here, this is a company that pays dividends on a semi-annual basis. So pretty uncommon to say the least. All right, moving on. Revenue, as you can see, right? I'm not going to go into the details again, but when you look at the revenue quarter over quarter, right? Great revenue accumulating. Um, their net income and free cash flow is also increasing. I don't usually look at this. This is fluff for me, so I don't really look at this. But the free cash flow is growing, which is something I really like to see. Earning per share, their EPS is growing and growing drastically. Cash to debt, again, cash is growing, as you can see. And what I like to see here is that quarter over quarter, it looks like their debt is gaining control, right? So there is a trend. The company is paying down their debt, right? So they're increasing their cash flow. They are increasing their cash flow, and they are also paying down some of the debt, which is a very good sign, right? This is a company that's trying to get their finances in order. Again, this is an insurance company. They work differently. They're always going to have loans open. That's the nature of their business. But the fact that they are trying to kind of close the gap on the income to debt or the cash to debt is really promising and impressive, right? Dividends are growing, so their cash is growing, their dividends are growing, and they're buying back shares. So again, overall, very, a lot of great signs here, right? So the company has enough cash to pay down debt and increase their dividends and buy back their shares. And they're still increasing their cash, which means that this company is well positioned. Their earning per share is obviously realizing a lot of the gains are coming from the share buyback. So this is a little bit inflated based on how much they've been purchasing their shares. But this is an added value to the stakeholders in addition to the dividends, which, as you can see, since the beginning of 2022, they were paying $3.09 a share on an annual basis. Now they're paying 354 cents a share, which somewhere around 10% growth year over year. All right. Once again, I don't know how CapEx is in the negative. I'm still investigating this. I am not sure what this truly means. But from an expense perspective, nonetheless, expenses are growing, and that's acceptable and that's expected. But I don't see their expenses is growing exponentially compared to their free cash flow, their earning per share, and look at the ratios. The ratios quarter over quarter, 2% or 1.73%, not great. But when you go to the annual, now we're zooming out and we're looking at the company, from the outside in, right? So this is an annual view of everything that we just spoke about, and the story remains intact but gets better. Revenue is growing. As you can see, there's a huge bump in revenue from 2022 to 2023. I do expect that revenue growth to continue. I am not sure what happened to their EBITDA, but again, this is not something I look for, so I don't really, or I look at, so I don't really spend a lot of time trying to analyze this. But again, my biggest indicator, I love free cash flow. This is how I get paid as a shareholder, so I want to always make sure free cash flow is increasing. Free cash flow year over year is increasing. This is 2023, so we have not yet seen anything from Q4. But if you do the math, $13.8 billion in 2023. And if you look at the quarterly view, this is an accumulative view. So far, they have generated $16.3 billion, and they have only reported on 2 quarters. So we still got 2 more quarters in the year, and they're already almost at the 2023 level, which leads me to think that this is a company that is going to, the cash flow is probably going to go anywhere above $21 billion for the year. Let me go back to the annual view. Net income, pretty steady growth there. I looked into this just to kind of see where the dip came from, and it looks like they increased their CapEx spending. And again, this is very wrong, so I'm not gonna talk about the CapEx here. But as you can see, there's a lot of CapEx spending that occurred in 2022 that impacted their EPS, impacted their net income. So this is probably an acquisition or paying down debt. Like I'm not sure what exactly happened. I haven't looked at deep enough in their balance sheets to figure out where that money went. But it looks like there was some an influx in capex spending, which leads me to think that this was an acquisition. Cash to debt story is still the same since 2020. They peaked at 2021, and year over year, you see their debt is decreasing, but their cash position is actually increasing. So again, another good sign. Dividend growth, great view. Shares outstanding, ratios. I see the ratios. I would like to see those ratios go above 15%. That's just the way I like to see ROIC. But at this time it's 6, and I know this is increasing as well. So if you add the two quarters, we're already at like 8 something. So this is also going to be increasing by year end. So if you add the quarters here, this is 1.6, 3 something, 6, 7. So it's at 7 or 8% at this point. All right. So I'm not gonna obsess so much over Chubb, but you guys get the point, right? Look at the valuation just to do some comparative analysis compared to Chubb's own valuation in the past, right? So even from a PE, which is not something I really put a lot of effort tracking, but even from a PE perspective, it looks like the company is still kind of fairly valued, right? So it's still lower than the 5-year average from a PE perspective. When you look at, again, I love cash flow, so I'm just going to go to the free cash flow. Free cash flow 7.74 versus 7.91 on a 5-year average basis. So again, another indicator, this is a company that is fairly valued. I won't say cheap, but very fairly valued company. Dividends, let's just kind of look at dividends real quick, because again, that's one of the reasons I looked into this company to begin with. Dividend safety, as I said, dividend safety is being really determined by their payout ratio. But when you look at the payout ratio, here's the payout ratio, 14.96. But when even looking at the payout ratio as compared to their free cash flow, so not the total cash in hand, but the free cash flow that they're generating on an annual basis, as you can see, it's only 10% of their free cash flow, which leads me to think that this is a company that's going to have another 89% of their free cash flow to pay down debt, repurchase stocks, and reinvest in the business. So another indicator from a dividend perspective, another indicator that this company is fairly valued, and from a dividend perspective, it's dividend safe. When we look at growth, this company doesn't have a lot of track record of growing dividends by high rate. So I don't expect this to go to 10% or 15%, which is usually where I like to see companies like this. But given the valuation, I am willing to kind of trade the valuation for a lower dividend growth. But again, I think from a growth perspective, they have been growing at 4%, which is way above current inflation rates. So I don't have an issue with this. And I do believe, based on the influx in free cash flow that they're having, I do believe that they could potentially even begin to expedite or elevate their increase rates in dividends. The reason I am making that assessment or making that assumption is because Warren Buffett is one of the people that just increased doubled down on their portfolio. So they had a position Chubb, but they increased their portfolio by somewhere like 97%, quarter over quarter. And I know Berkshire specifically, they do invest and they do look for companies that are really increasing their dividends. That's how they make most of their money. Last, and I'm gonna top up to this one, but lastly, from a metrics perspective, I did just kind of created this view for everybody just to kind of again reiterate what I just said. So price to free cash flow, I charted that on the chart. As you can see, the price to free cash flow is continuing to go down, which means the company is becoming cheaper and cheaper. Again, it's hard to really describe when a company is actually at all-time high, right? But as you can see from all the fundamentals that I've been sharing so far, this company, even though it's hitting all-time high, this company is getting cheaper. Free cash flow yield, something I really like to see, right? Free cash flow yield is actually increasing, right? So again, another great sign of a company's undervaluation. Earning per share has been growing. Net profit margins, they're not giving up margins. Their margins have been a little bit over uh, in the range of 17 to 21%, with exception to December 2022. Again, this is probably due to some type of acquisition that they made. That's kind of corresponding back to that really dip in net income and free cash flow that we saw in 2022. But overall, I think they're averaging somewhere around like 18% from insurance for an insurance company. This is really, really attractive. And last but not least, um, is the profit margins. So, I just kind of spoke about profit margins. All right, so that's pretty much what I wanted to kind of cover on Chubb. But I have a very small position in Chubb, so I just kind of nibbled at it at 272. It's at 290. It keeps making all-time high, and I'm just waiting to see if I can pick up some more stocks at 280 or 270, hopefully. But great company, in my opinion. Great long-term holding. This is something that I do plan to hold for at least 3 to 5 years to kind of see the benefit from holding that company long-term. But as I just mentioned, and as I just showed on the screen, right? So everything is leading me to think that this is a company that is going to continue to, the fundamentals are going to continue to improve, and they're going to continue. The price is going to follow eventually. It may take a break and it may trade flat for a while since it's at an all-time high, which is something that I do expect as well. But I'm not, again, my positions are usually 3 to 5 year positions. So kind of linking that back to my Lulu comment, any money that's going to go out of Lulu is probably going to go into Chubb if I see a dip and if Lulu goes back to 280. And I know we're actually over time, so I'll stop here and see what kind of questions we do have. AXON. I'll check that out now. Wow. Look at the revenue. Free cash flow. Okay. Yeah, I'll need to do a little bit more research on this one, but this looks good. So it looks like it's a fairly newer company, or a company that was not really profitable and starting to become profitable. But the one thing that really stands out are these two things. Their ROIC, which is annual, right? Yep, annual. Return on invested capital has been historically lower and it's actually trending down. So that's not something I like to see. That means the company or the leadership management is allocating money in the wrong places, perhaps, unless there's another explanation for it. I can't really tell. Um, and the shares are increasing. And if they've been buying everybody out, that's pretty much not a good sign. I like organic growth. I don't like synthetic growth, and acquisitions are not usually good for the business. Yes, it may look on the EPS perspective, or it may look good from a net income and even from a cash flow perspective. But when a company is acquiring its way to the top, is not a good sign. But again, I don't want to make assumptions. I'll look into this. I'll deep dive into it a little bit more, and I'll share my thoughts on Discord. But looks good from an outsider looking in. It looks great. I don't like their free cash flow yields, pretty low. Their margins are pretty low. So again, I don't know what industry they're in, so I can't really make that correlation right now, but I'll take a look into it a little bit more. All right, Chipotle. Where do I see Chipotle? Um, I don't know, guys. Chipotle. uh, There is a lot of moving parts for Chipotle lately. I mean, again, fundamentally speaking, I mean, look at the view. I don't need to talk about it anymore, right? Buying shares, their return on invested capital is at 22%. Their EPS is exploding. Free cash flow pretty decent. So everything looks good from a fundamentals perspective. With that being said, and with inflation getting under control again, the only risk to Chipotle is really the valuation, in my opinion. From a valuation perspective, Chipotle is very saturated from a on a value perspective. You can look at their PEs and you can make that determination. You can look at their free cash flow. You can make that determination. You can even look them up and compare them to their own history, and the story would not change, right? Um, their valuation, these valuations are no longer realistic. Their growth is going to be decreasing. This is a company that is going to be maturing and has been maturing. So even though from a valuation perspective, this may seem to be a little bit undervalued. I do believe this is compared to the market, compared to the overall market. This is a company that's really, really heating up. So the valuation of this company is really what's giving me a little bit of a concern. I hold positions in Chipotle. I am not gonna lie, I trimmed some at the $57 a share. Just literally 5% of my position, so it didn't decrease much. Again, I am trying to raise cash, and I'm looking at the technicals of these companies, and I'm trying to see if they're above their 200 moving average or lower, below the 50-day moving average. And I've been trimming some off the top when the opportunity presents itself. But I'm going to continue to hold it. I'm not going to completely set out of it. But the things we need to watch for is, again, making sure that we know who's going to be the new CEO, what their vision of the company is going to look like. That's something that's still up in the air at this point. Valuation we spoke about. I also want to make sure that this whole portions issue kind of goes to bed. I know they have been marketing and announcing some robotic based portions that they are going to be using technology to really just kind of make sure the portions are consistent across the board. So that was good news. But again, it was just a pilot. And a company as big as Chipotle, I think this is probably going to take about a year or two to kind of deploy in all their businesses or all their stores, if they decide to deploy it in all stores. But it's still in pilot at this point. So overall, I am going to continue to hold Chipotle. Chipotle is another consumer cyclical company that I do hold. Hence, I am trimming some of the consumer cyclical just to kind of decrease my overall exposure in that to that specific sector. But overall, I think Chipotle is a great company. I have no issues with the way the fundamentals are playing out right now. And I don't see this company slowing down anytime soon, to be honest with you. Their locations are increasing. This is a company that have been historically profitable, quarter over quarter, year over year. No matter how you look at this, this is a company that have been using their cash properly, increasing their cash. Shares outstanding, so they've been buying back shares. I would love to see Chipotle end up paying some dividends. That's another reason I'm lowering my exposure in Chipotle, just because they don't pay dividends, and I am trying to gravitate a little bit more to companies that pay dividends. The ratios are pretty impressive when you look at it on a year-over-year basis. 22 to 20 to 22, 19%, 13%. This is a company that is turning their cash into gold. You cannot. It's so hard to find a company that is going to return 22% on an annual basis for every single dollar that they invest back into the business. So all that capex money, is really going to a good place because you're seeing that money turned into 22% on an annual basis, 19% for 2022. And as I said before, this is probably going to be somewhere around like 26, if I recall correctly. I haven't looked at it in a while, but if you look at Q1, that's 6%, that's 13%, and they still have 2 quarters in a year. So I do expect this company to return somewhere on like 25 to 26 on their capex spending for the year of 2024. So I love the company. I would love to see it go back to the $45 share range, and I'll probably buy a little bit more at that point. But at this time, I'm just holding, and when the price moves to a good range, from a strictly technical perspective, I'm trimming some at the top, and then I buy some more at the dip when the dip, if the dip occurs. But that's kind of my position on Chipotle. I'm not getting out of it. I would love for them to start paying some dividends, so I don't have to exit completely from that position. Hopefully that answers your question, Ed. Hey, Freddie, did you want to go on speaker?
Can you hear?
You're breaking, sir. Breaking. I can hear you, but I can hardly hear you.
It's skip too hard.